Nerd alert! Property Nerds, the home for data-driven property investors, where we uncover Australia's hot and cold markets, latest headlines and trends.
So guys, I reckon this particular episode, we're going to save thousands, if not tens of thousands of dollars for a lot of people out there who didn't know this stuff. But secondly, I reckon for anyone watching this, listening to this episode, you're going to be able to save anywhere between 3 to 5 years, if not longer, on your investment journey based on some of the mapping we've done in the past, just by staying to the end of this episode. There's lots of stuff we're going to cover that most people don't when it comes to this world of finance, and we've got the right people to do it. So I'm here with Jack. I'm here with Adrian. I'm Arjun. If you haven't met me before, I'm the one of the co-hosts here of the Property Nerds podcast. And we've got Jack from Fouracre Financial, and we've got Adrian from InvestorKit, our senior portfolio strategist. So, Jack, I want to jump over to you on this first one. Lender's mortgage insurance. It's taboo to some people, but I think it's the greatest thing since sliced bread. Not the insurance, but getting the 90% loan. There are obviously costs to occur from having to pay lender's mortgage insurance when you're taking loans above 80%. But there's a list of professionals out there. And this professional base gets waivers, meaning they don't have to pay that cost and they can access higher leverage. Could you tell us some more about these professionals, who they are, what type of profession gets them, just from your side?
Yeah, so you have what's called a professional package. So like accountants or solicitors, they'll get there's a fair few lenders. This is pretty well known. Like if you're an accountant or a solicitor, you can get an LMI waiver. Same as the Medico, what's called a Medico policy, where you'll have LMI waivers, but there's a lot of LMI waivers for Medico that go up to 95% even. But as well, if you're a doctor, or there's other types of doctors that can get LMI waivers, and then there's like a second tier to the Medico where you've got people that might not know that they have access to it, like nurses or what's a good one, midwives as well. Like so people that, and you'll be very surprised. So reach out if you're in the industry and you're not sure if you would qualify for LMI waiver. You might be surprised because there's a whole big list of second tier Medico policy that you might fit the script. But and
is it 80 to 90% always, or can it go from 80 to 95% with some types of properties in terms of the waiver? Like where's the waiver end?
On the Medico, like if you're a GP or a specialist, you can go up to 95%.
Yeah, wow.
Yeah, which is really good. But something else worth noting, it's kind of similar. It's not LMI waiver, but there's a essential workers policy. So essential workers usually, during COVID, a lot of nurses and doctors and stuff, you could annualize the income over 100%. So generally when we're doing borrowing capacities, you'll take the base income, then you have overtime and allowances and all that. That's generally shaded to 80%. But with an essential worker, you can annualize the full income and use 100% of the overtime and everything. And that really opens up borrowing capacity when you can do that.
Massively.
Oh, mate. So when you've got an essential worker,
and who fits under the build of essential workers these days? What are some of them? It's
the one that everyone would know would be like firefighters, police, nurses, But recently, there's been a couple of lenders that are bringing out stuff that I've never seen it be expanded to this level. Like
what are you saying?
Train operators.
Yeah, that's pretty cool. So we didn't even know that. Hey, that's
pilots,
pretty cool.
Flight attendants,
right?
Counselors, social workers, aged care, disability support workers. So these are very new things that and it just really opens up their borrowing capacity. Even childcare workers. And
if I'm not mistaken, there's also like certain sports professionals that can get it. And even like media personalities, like certain media roles. So I mean, the list is quite extensive, and I'm almost positive there's going to be so many people out there that don't know, like, if they fall under a criteria. Now, I am going to fill your inbox up a little bit with this request, but I want to, because the list is massive.
Yeah.
How can people reach out to go, hey, I've got a mortgage.
Yeah.
I'd like to speak to someone, and I want to know if I can get mortgage insurance waivers, because that could be the ticket for them to either, A, unlock equity to build a portfolio, or they need cash for renovations, other things like that, and they want to access that in their home. How can people get in touch?
Yeah, so just go to fouracrefinancial.com.au. You can either book in a meeting directly there, or you can put in an inquiry and someone will reach out.
Perfect. Now, we'll put it in the show notes as well. It's fouracrefinancial.com.au, and it is a game changer. Now, just to make it real for people, how much money do people save for, say, every 500 or 600K purchase price when they are saving on LMI? Where does that number roughly sit?
So depending on if you're borrowing 90% or if you're borrowing 95%. So at 90%, you generally save about 2% on the purchase price. So
that's massive.
That could be like $12,000 or all the way up to close to $20,000 depending on the purchase price.
Yeah.
But yeah, that's huge, man, especially if you're accessing equity up to that, because if you have to pay LMI, then you're cutting into the deposit and you're taking away from the wealth and the equity growth. So yeah, it's huge.
Now, one of the biggest things that me and you talk about, Adrian, and firstly, I bet you, like, me and you were sitting here, we're like, we're not essential workers? Like,
we worked through COVID, mate. Hey, to this day, there's still no LMI waivers for brokers, mate. What's going on?
Mate, that's funny. You're funding all of that. You're not getting it. But now, look, we're not that special. We're definitely not essential. In terms of, Adrian, I want to come to you for something, because this we see way too often, right? People go, I don't want to pay LMI. And look, maybe they don't get a waiver. Let's just say there's certain people, because the majority don't, right? So the majority don't get LMI waivers. I don't want to pay LMI. Jack said about 1 to 2% of a cost of doing business to get there. What's the opportunity cost for people if they're trying to go, well, I'll wait and save to get that 20% deposit and I'll then get on the market, versus go pay LMI, or in the professions Jack mentioned, get the waiver? How does it impact portfolios from what you've seen?
Yeah, look, it's a very common issue that a lot of clients have, or a bit of a dilemma that they face. And I think if I sort of run through just a couple numbers to make it a little bit more real, we use a 600K example property, comparing a 12% deposit versus a 20% deposit. Now, the difference that you actually need to create that deposit is about 48K. So
that's a fair bit of savings, eh? 48K, that doesn't happen overnight.
Yeah, exactly right. And I think if we were to just use some rough sort of calculations, people or households save different amounts, but I've just taken a nice easy amount of 2,000 savings every single month for the household. That's an extra 2 years to build up that deposit. So
2 years.
It's a lot of time.
Yeah.
And Jack, as you mentioned, LMI fee, let's call it, I'll make it nice and easy. We'll just use 10K as an example. But if you have a property that is 600K, and it goes up by 5% for those 2 years that you weren't in the market, we're talking about 60,000 in terms of that opportunity.
Missed equity of 60,000, 2 years of saving. Like this, cause remember, like, people don't even think of missed opportunity just in the cash, but there's also time and life. It's pretty big.
Yeah. So it's a big, it's a huge amount when it comes to 60K of missed equity. And the cost of that is, what you mentioned there, 10K LMI. So you got to weigh it up. And this is on a very conservative 5% growth on the 600K property.
A lot of people don't know this as well. If you go in and pay LMI on the way in, if you refinance that property without LMI within 2 years, you can actually get a partial LMI refund.
Wow. That's pretty interesting. And who do they go to submit that process? Is it direct to the bank?
To the bank, yeah.
Got it. So you heard it here first, or maybe second or third. We're just going to call it first. LMI refunds, if you've had that 2 year period and you've basically paid the LMI and then now you are able to avoid paying it, whether it be loan reduction or value increase, worth checking it out, having a chat with someone. But what you've just said there, Adrian, is pretty important to point out, because not only are we talking opportunity costs from 60K equity growth, but then secondly, we're also talking about it from like the markets. What if your budget and borrowing capacity is 600? You now maybe have multiple cities and markets don't fit into your borrowing capacity anymore because the prices themselves are 660. So that asset you could have jumped on, the 60K you'd have saved in growth. And then the third thing is you would bring forward your portfolio plan and make it earlier because you're making an acquisition sooner. And that's even if you paid LMI. But if you didn't pay LMI and you're one of those professions, not only can you access your purchase sooner, but you can really start building momentum in the portfolio. Now, we've touched on if we're just trying to save LMI, like how much cost, how much you save in cash. But Jack, there is other options, like going to 90% or saving LMI isn't the only thing. How can other people get into the market with lower deposits or no deposits outside of LMI waivers or paying LMI?
So if you're going down the owner-occupied route, it's pretty well known that there's a lot of first home buyer benefits of, like not having to pay LMI, but having to put a low deposit. Single parent low deposit schemes, first home buyer low deposit schemes. But you've also got the guarantor option, which is pretty valuable. Like you can even do that for investment, like your first investment property, you can use a guarantor. So like if your parents have a property that has equity in it, they can put their house up as security so that you can borrow 100% of the purchasing costs plus borrow the stamp duty. You can even borrow the buyer's agent fee on top as well. So that's, no money down essentially, and you're just borrowing the full amount. So some people have even had a deposit that they could have used for their first one, but rather than using that, they go down the guarantor route and then
have the liquidity,
buy
right?
another one, buy a second property with the cash they had.
That's the perfect scenario for people with the borrowing strength, but like cash smarts or cash poor, right?
Yeah.
It's like I can either not have the cash, have the guarantor, but I'm borrowing strong, my income's strong, and I can support it. So I think just to clear it up for people that might be new to this, with the first home, it's like 5% deposits, right? Rather than 10 or 20 with LMI waivers. Is that correct?
Yeah.
And then with single mothers or on that first, is it 2%?
Yeah.
Wow, 2%.
It's difficult though, because if it's a single parent, it's one income, plus there's dependents.
It's kind of like you're getting the 2%, but you also need the income servicing, right?
Yeah, the borrowing powers generally doesn't work for what they want. So it just depends.
Yeah. And then guarantor can borrow up to 105 or 107%.
107, yeah.
107, which covers costs, professionals, and purchasing.
Yeah, they say 100%, like 104%, which is like stamp duty, and then 3% for purchasing costs, which is like agent fees, buyer's agent fees.
Yeah. Now, my last question on this one then is, maybe it's not a question, it's more like a statement. People make this mistake way too often. They see the media, they think time to save a deposit stat, or how much I need to be able to buy in a certain city, and they get told all the wrong figures because all over the media is 20%.
Yeah.
20% this, 20% that, 20% this, when we know that in 5% of $1 million is $50,000, right?
And they use Sydney as an example. Like
it's
20%
always
of $1 million.
Sydney.
Oh, you're going to save 250 grand? Yeah, right. But like if you look into state, mate, you can get into a good property if you've got 70K saved.
Absolutely. Now, let's just say there's houses in Brisbane for under 750K, and if you're a first home buyer at 5% of that with no stamp duty, right, or 750K or some stamp duty even, that's 35 to 50K all up to buy that property. And I think that part itself, just the misinformation, is going to help people, is going to hold so many people back. Yeah. Simply because they go, oh, I can't do it. Why even give it a go? And then just allocate money in different areas, don't even consider it. So yeah, it's a big thing. Loving the show and keen to invest? Well, book your free discovery call and we'll actually walk you through how to build a high growth portfolio without all the guesswork. Just jump onto the link in the show notes or visit investorkit.com.au to book your discovery call. And now let's get back into the show.
Hey Jack, you and I have collaborated quite a lot when it comes to clients and, client strategy, scaling up portfolios. And I think one thing that we've noticed is through the use of all of these exceptions and special conditions for a lot of clients, we've gone from a client who thought they could only purchase one property to maybe purchasing 2 or 3 with these exceptions, structures and things like that. We use trust structures a lot and they're becoming a lot more popular. Which of these exceptions can you kind of use within trust structures that flow on through?
Yeah, so when you're purchasing in a trust and with a corporate trustee, the debt isn't against you personally, it's within a corporate trustee structure. So when you're borrowing in your personal name, a lender's going to look at your personal credit report and they're going to see that debt and put a 3% buffer on it, right? So on actual figures, it might be positively geared, but when they add the shaded rental income, property investment expenses, assessment rate buffer, typically that would show on paper that it's not, right? So, but when you've got a scenario where that's in a trust, well then you can get an accountant's letter to exclude that and you go and move on to a separate trust or preserve your borrowing power in your individual name. So I think where a trust is most suitable for a client is a couple reasons. Like if they don't currently have a principal place of residence, but that's something they want in the future, going down the trust route early in the piece to preserve their borrowing power individually so that when it comes time to purchase a owner-occ, they can maintain their properties. Or if they had to sell them to generate a deposit, it's in a trust structure that's going to give them a better tax outcome on the way out. Or if you've committed to building a portfolio, you're going to be that person that wants to get a large portfolio. You don't have to wait until you've run out of your borrowing capacity to get into it. If you're going to get into having a lot of properties, getting into it early, getting into the trust strategy early can definitely have benefits in the back end. So
now on the trust, do any LMI waivers flow through? Because it's a corporate entity, it's not you. Are there some banks that are anti it, some banks that are, we'll sort it out there? How does it work?
Some banks do back out for those LMI waivers and professionals, but there are still banks that would still operate in the LMI waiver space for trust.
Yeah, interesting. So it's definitely worth, just checking it out. Okay. Yeah. So that was a big myth that's out there. They're like, oh no, don't do it because you get LMI waivers. So you don't get LMI waivers. So that's actually good to know. Adrian, I'll come back to you on this last one, which is more about knowing that you can go to 90%, knowing that you can get LMI waivers. There are people that pay LMI and then their property values have gone back down to 80, right? And whether it's a combination of values going up or mortgages being paid down, they are now going, oh no, I don't want to purchase another one because I don't want to take it back up to 90. How does that work in the opportunity cost thought, or what are your thoughts on that?
Yeah, there's a few sort of considerations, and you'd probably see this as well, Jack, when it comes to people who have purchased at 90 and they've got a few options. You can stick it at 80%, and then you won't have really much equity to tap into. That's just how it is, and maybe you get a slightly better rate. You can also refinance back to 90% within the same lender, and then you'd only have to pay the LMI on that additional portion of the loan.
See, that's a big one. People don't know that. They think they have to pay it all over again, but it's only a top-up. Is that right, Joe?
Yeah, that's right.
Yeah.
So that's the good option. Although the consideration as well is that if you do multiple vals and you go to different lenders, then you can have a few options. Yeah. And as we know, vals can vary quite a lot from lender to lender. Your lender might not give you a great val, and then you go, cool, I can't really pull out that much equity from who I'm with. And then that opportunity cost is, what if you did refinance? You went to a lender who gave you a much better val, and it gives you that equity that allows you to get that deposit for the next property.
Yeah.
Yes, you do have to pay your LMI again, but as Jack said, maybe you get a little bit of a clawback, or you get a bit of it back if it's within that 2-year period. But it comes back to the same principle, where if you were to save up that deposit, once again, in that difference of equity that you can access, that could take you another 2 years for that purchase that you're making as of right now, rather than 2 years later. That could speed up your plan from 3 to 5 years in terms of you actually getting to your goal, because it's got such a big compounding effect of you purchasing earlier.
What I love about that is that you can actually visualize that, and you do that often for clients, because if you now have the 2 600K properties and all of a sudden you say you don't have LMI waiver, you have these 2 600K properties, they go up in value, you've got 120K in equity, and then you go, oh, look, these vals that have happened for me to get that equity out, I need to pay another 10 per property on LMI. That's 20. You still have 100 accessible equity after the LMI that you can come pull out. Now, if you've done that, that's almost a deposit on another property plus some cost, depending on that purchase price. And suddenly you now, instead of waiting 2 to 3 years of further growth, savings, or anything like that, you have to decide between that or pull it forward. So I think pulling it forward allows you to really bring forward also a property into your portfolio, which is now 3 assets compounding instead of 2. So guys, it's been an awesome little masterclass on LMI waivers as well. So if you're in professions, that some that we've mentioned today, or if you're unsure if you're in that profession or if your profession is covered by it, reach out to the Fouracre Financial team at fouracrefinancial.com.au. Jack and his team will be able to assist with regards to reviewing your suitability on LMI waivers and eligibility. And if that is there, you could be skyrocketing your portfolio. But at the same time, if you don't have those waivers, you've just seen how Adrian's brought forward the understanding of opportunity cost and how using that leverage can get you ahead with building a portfolio. So that's it from us at the Property Nerds. And don't forget to like and subscribe. Thank you so much for tuning into this podcast. To hear more like this and to help us spread the word, don't forget to leave us a rating and follow along for our next episode.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Game over.